Got it.
Good afternoon and welcome to the March 19, 2026 regular meeting of the Finance and Risk Management Committee, FRMC. I am Dita Siamani, Chair of the FRMC, representing the City of National City. We welcome members of the public, community power staff, and committee members joining us in person at the City of Chula Vista Council Chambers. I now call the meeting to order. Ms. Sandra, please call the roll.
Director Insunza.
Here.
Vice Chair Suzuki.
Here.
Chair Yamani.
Here.
I have a quorum, Madam Chair.
Thank you so much. Let us all stand up, face the flag for the Pledge of Allegiance led by Councilmember Insunza.
Please stand if you can. Ready? Begin. I pledge
Allegiance to the flag of the United States of America
and to the republic for which it stands, one nation,
under God, indivisible,
with liberty and
justice for all.
Thank you. Next, we acknowledge that this meeting is taking place on the land of the original inhabitants of the Greater San Diego region. A land acknowledgement is a critical step toward working with Native communities to create meaningful partnerships and inclusion in the stewardship and protection of their cultural resources and homelands. Let's take a moment to honor these ancestral grounds that were the traditional lands of the Kumeyaay. Thank you so much. Madam Clerk, are there any items to be added, withdrawn, or reordered of the agenda?
Yes, we do. We will reorder item number 6 to go first.
Okay, so directors, we're moving up item 6 before we move on to the other agenda items. And the item 6 is our CEO. Madam CEO, you have the floor, ma'am.
We need to take public comment first.
Sorry. Okay. Okay. Public comments. Prior to that, we have to go to public comment. Are there any, this is an opportunity for members of the public to address FRMC on any items not on the agenda, but within the jurisdiction of the FRMC. Members of the public may provide comments in any manner prescribed above. Are there any public comments, Madam Secretary?
We do. Rob, may you please approach the podium? You have 3 minutes to address the FRMC.
Sounds like we're good today. Hello, San Diego Community Power. This is the Finance and Risk Management Committee. So definitely risk management is a preview of your guys'. I came to your last meeting and I spoke about battery storage and concern that residents have putting them in our neighborhoods. You know, I have a battery at my house, so I'm not against personal use, but to have like a business in the neighborhood, I just want to reinforce that to you guys that maybe business districts or out of the way areas by the solar farms or something where it's more direct to where it's going to be charged from. You know, you have to forgive me, but I don't know of any solar farms in Chula Vista. Just have to forgive me. You know, maybe the city of Chula Vista is the biggest solar farm because they own the most like property with solar and huge rates. But yeah, it's just risk management. So recently at some of the local meetings, they've been trying to implement like new rules So they want to put in a solar charging array with a battery, independent of the grid and at parks and remote locations. Now, as a resident, I still can't even do that, right? And this has to do with our energy contract. So if you guys aren't aware of the city planning new initiatives that, affect our contracts, just try to bring it up to you. Something I know personally going to my local meetings. I'm not gonna know about National City because I don't go to National City meetings. But I do attend Chula Vista, and I think it was Parks and Rec, but it probably came up in the Sustainability Commission too. They kind of go hand in hand. I do know when the sun shades, we need power. So I'm on the 50-50 plan because I just know that's the realistic outlook. I encourage you guys to, do what you have to do, but stay within the boundaries that this, we're representing the people who can't afford it, and then we're going to push all these $1 million ideas onto them. And so we want to see those savings when you guys say, oh, we're going to save you money in the future by switching to these systems. So reinforcing that and giving a clear outlook to the people is something that I'd like to see also for transparency. Thank you for my time, and I appreciate this being open to the public.
Thank you, Mr. Robert. Moving on to our item number 6. Announcement of public investment grade credit rating from S&P Global Ratings. Our Chief Executive Officer will present this item, Ms. Karen Burns.
Madam Chair, we need to do the consent item first. We need a motion
after that. No?
Can I do it after that? That's
You can do
fine.
We can do it after. Okay, so
So, Madam CEO, it's your item first.
mine first. All right, good afternoon, board members and members of the public. I wanted to share some very positive news. I am pleased to share that Community Power has received an A stable credit rating from Standard & Poor's. This is a significant milestone for our organization and a strong external validation of the disciplined financial stewardship, governance, and risk management that our team and the Community Power Board have consistently delivered. This rating reflects years of thoughtful decision-making and a shared commitment to building a resilient, financially strong public agency that can serve our communities for the long term. Next slide, please. Standard & Poor's recognized in its rating a number of credit strengths of Community Power, including our diverse customer base, our strong governance and experienced management, our sound financial profile, low operational and climate risk as we move towards that clean energy future, and our strategic renewable vision. Next slide, please. An A stable credit rating strengthens our ability to manage risk, secure more favorable financing and contract terms, and continue delivering reliable, affordable, and clean power to the communities we serve today and well into the future. Importantly, a public credit rating also brings an ongoing level of accountability. S&P will conduct regular surveillance, and we will continue to be measured against the financial discipline that supports an A category profile. That external oversight reinforces our shared commitment to maintaining strong liquidity, operating performance, and risk management practices. I want to extend my sincere thanks to each of you for your leadership, partnership, and unwavering focus on sustainability, affordability, and organizational longevity. I also want to recognize our exceptional staff, whose professionalism, fiscal discipline, and commitment to Community Power's mission made this achievement possible. This outcome is truly a collective effort, grounded in strong board oversight and executed by a highly capable and dedicated team. I would also like to thank PFN, our municipal advisors, who helped to make this all possible. And thank you, board and public, for your trust and support. I'm proud of what we've accomplished together and excited about what this milestone enables us to do next. Thank you.
Thank you, Madam CEO. Congratulations. Thank you so much, directors. Do you have any comments for our CEO? Vice Chair?
I just want to congratulate our CEO and our staff. You guys have done a great job, and thank you for your guidance and helping us to really, this is a huge, I think it's a huge accomplishment for the organization, and it bodes well for our future.
Being that we're such a new organization, it speaks highly of not only you, but the entire staff and all the diligent work that everyone puts in. And it feels like this organization has been on for 20 years because of that, such an incredible reputation that everyone speaks of it countywide. And that's why everyone wants to jump board. And we'll take Coronado, we'll start taking all these cities one by one until we get all 18. But congratulations, CEO, and I appreciate everyone's diligent work. Good job.
Thank you, members. Madam Secretary, are there any member of the public or questions for this item?
We do have a member of the public. Robert, can you please approach the podium? You have 3 minutes.
Back. I appreciate my time. I gotta imagine a lot of people are busy with work and trying to do things, so cover a lot of points. So you're gonna have to forgive me if some of my information is incorrect. I'm trying my best here. As far as item 6, it is encouraging to see San Diego Community Power achieve a credit score rating and the 27 million in savings it brings by reducing collateral requirements. However, the S&P report includes this packet contains warnings that the public deserve more transparency on. First, S&P identifies local capital factors as a risk, noting that our rates are already 150% of the state's average. This suggests we have very little flexibility to manage future cost increases without hurting customers. What is the long-term plan to bring these rates closer to the state average to protect our credit stability? Second, when the rating is stable, S&P explicitly stated that they would lower the rating if our delinquent amount impaired cash flow, we are carrying 61 million in debt over 120 days past due. How does the agency plan to resolve these massive residential debt without resorting to shutoffs that the state regulators are already concerned about? Finally, S&P bases its rating on financial performance, yet today's treasurer's report includes a completion of an accounting firm that is not independent and has omitted nearly all standards disclosure. Did S&P have access to the full audited disclosures that were omitted from the public package? We need to ensure this A rating isn't built on a foundation of uncollected debt and unaudited members. Thank you.
Thank you, sir. Thank you for your comment. Thank you, Madam CEO. This is a recommendation is received and filed. Staff report acknowledging San Diego Community Power's publicly issued issuer credit rating with a stable outlook from S&P Global Ratings. So with that said, we move on back to our first page of the consent, non-agenda public comment. Okay. We will now take up non-agenda public comments and written public comments.
Yeah, we took a non-agenda public comment. We're on the consent calendar.
Where are we?
Only one item, the approved February 19, 2026.
I missed that page. Okay. Page. Okay. We will now move on to our consent item. Page 2.
Motion approved.
Second,
Approved. We will now move on to consent item approved February 19, 2026 meeting minutes. Do any members wish to pull the consent item? No. Sandra, do we have any public comments on the consent calendar? Are there any committee member? None?
Do not,
We don't have
I do
any.
not, Madam Chair.
Okay, so we have a motion and a second. Can we please call the roll?
Director Insunza,
Yes.
Vice Chair Suzuki,
yes,
Chair Yamani,
Yes.
motion carries. Madam Chair.
Thank you. We will now move on to regular agenda items. Item number 2, Treasurer's Report for 6-month period ending December 31, 2025. Jeb Spangler, Senior Strategic Finance Manager, Interim Treasurer, and Dan Delaney from Chandler Asset Management will present this item.
Do we need to also approve the minutes?
That was
Yeah.
number 1.
We did?
Yeah.
We just did that.
That was the consent calendar.
It wasn't the consent calendar. There was one item. on the consent calendar.
Only one, just the minutes.
Okay, okay, sorry about that. Thank you.
Okay.
I want to be sure.
No, thank you. So we will present first and then we will have comments after, right? Okay, so it's Jeb and Dan Delaney. Mr. Spangler, it's your turn, sir.
Thank you, Chair Yamani. Jeb Spangler, Senior Strategic Finance Manager with and Interim Treasurer at Community Power. Again, joined by Dan Delaney with Chandler Asset Management, our investment advisor. Next slide, please. We're at the halfway point of the fiscal year 2026, and through December 31st, 2025, we're tracking just in line with total operating revenues with respect to what our budget was at just 0.7% below the budget. Operating expenses are 10% below budget, largely driven by kind of conservative power cost assumptions that were in our budget, as well as just timing differences with respect to when our invoices are due and payable. Year to date, we've recorded $762 million in net operating revenue versus $586 in total expenses for a positive $176 million in net position. Next slide, please. Month over month, our operating income against the budgeted net position remained positive in December at just over $4.15 million versus a budgeted net position of negative $2.1 million. Next slide. Our days cash on hand trend continues to be positive through the end of this fiscal year, to the first part of this fiscal year. As of 12/31/25, we are just above our target, our new target of 225 days at 231 days cash on hand. Just reflecting on the trend that you'll see off to the left of this chart, and just want to point your attention to, we expect to see a similar trend where reserves start to dip over the first 3 to 6 months of this calendar year. That's a trend that we typically see year over year, and kind of expect to see that again over the next couple of months. So while it's positive that we hit our new target, we do expect that that number to actually decrease over the next couple of months. Next slide, please. At the end of 12/31/25, our investment total was $640.3 million. We also have $227 million in available letter of credit capacity, which supports our overall liquidity and credit strength. The composition of our liquidity is built by $537 million in unrestricted cash, $5.9 million of current investments, and $97 million of non-current investments. Next slide, please. Investment returns through the end of 12/31/2025. Monthly investment income where it was in line with previous months at $1.7 million for a total accumulated investment income in fiscal year 26 of $8.2 million. This investment income helps offset costs and strengthens our overall financial results. Next slide, please. Prepay continues to deliver real customer value. This slide reflects $6.1 million saved between the first quarter of 25 and the fourth quarter of 2025. Just an important update. We actually just this morning closed our third prepay transaction, which will deliver an additional $43.2 million in total savings over the next 10 years. We'll bring more results of, or more details of the results of that prepay transaction in a future meeting. But wanted to announce that here tonight. Next slide, please. Finally, this is our participation by jurisdiction. It looks very similar to last month's. It's incredibly stable at 95.5 participation rate. And with that, I will actually turn it over to Dan Delaney to discuss our quarterly investment update.
Nice to be here, Madam Chairman and Vice Chairman of the committee. Pleasure to represent Chandler's, your investment advisor. Very pleased to report that the agency's investment program is very safe, despite all the market volatility, and we can talk a bit about that. And highly liquid and producing solid returns that really support your strategic objectives. We can firstly kick off with the economic update. We're heading into this year, we're quite positive on the economy. Job growth, as you can see, was slowing, but the unemployment rate was near a record low. There was the expectation there would be some stimulus from the tax bill last year, which would carry over into this year and really support consumption and also business investment. And then, of course, recent events have unfolded, and that does pose some risks to the growth outlook. Although what I would say is that the US's economic position is relatively resilient, certainly when it comes to being an energy producer and being independent as an energy producer. We're expecting the economy to soften, but not to fall into recession at this stage. We can go to the next slide. This is the other side of the Fed's dual mandate, which we'll talk about in a second. The Fed cares about keeping unemployment low, but also keeping inflation low as well. And again, as we were entering this year, the inflation backdrop was improving. And as the Fed was looking at these balance of risks, it was really thinking about employment and job growth slowing. And for that reason, it was more geared towards lowering interest rates. We had a Fed meeting yesterday, as you may have seen, and the output from that meeting was that the balance of risk started to shift away from employment and more towards inflation. And really the risk is around the duration of this conflict in the Middle East. The longer it goes on, the more of this key energy infrastructure that lies in that region becomes damaged, as permanently so, and that could lead to inflation expectations rising. And the Fed, that is the number one concern with that. The inflation expectations rise, and that what it may have to do, and this is a very high bar, but to actually tighten financial conditions and increase interest rates. Now that, like I said, is a very high bar. That is not our base case, but certainly interest rate cut expectations, which were penciled in for this year, at least one or two, have now been penciled out and may be pushed into next year. But again, it's a very fluid situation. Even the Fed said yesterday, we don't know. They said that a number of times. It's very hard to have any conviction with what's going on right now, but certainly our expectation is that any interest rate reductions will be pushed out potentially into next year. So that has impacts on your portfolio in terms of the interest earnings. They may stay higher, but also your cost of capital may stay higher as well. We can flip to the next few slides. So this is the Fed funds rate. It's ended up at 3.5 to 3.75%. Like I said, we're expecting it to travel closer to 3% this year, but maybe next year. And the next slide. This is the bond market. So bond yields were declining in expectation of those Fed cuts. And now in the last few weeks, we've actually seen bond yields increase. So it's quite interesting that what you'd expect in a volatile market, particularly one where there's heightened geopolitical risk, there would be a flight to quality and investors fleeing to bonds. And this situation is a little bit unusual because we have this inflationary concern, and bonds, of course, don't perform well in that environment. So we have seen some volatility in both the stock and bond market. The important thing for you to know is that your portfolio is very insulated from that volatility. We can talk about that on the next few slides. These are our objectives: safety, liquidity, and return. Safety and liquidity come first, of course. Return follows. We have a benchmark which we want to outperform over time and add value, and we do that through diversifying across a range of high quality sectors within the fixed income world that are permissible by your policy. and by California code. Go to the next slide. So this is a snapshot of the portfolio as of the end of December versus the end of the third quarter, September. You'll notice that this is your total investment portfolio. So it consolidates all of the investments that we manage at Chandler and those investments, those more liquid investments that you hold elsewhere. You can see that the total went up at the end of the quarter from around 450 to 650. So you have a very strong level of liquidity within your portfolio. Go to the next slide. Potentially the most important statement in my presentation here, your compliance statement. You are compliant with all different parameters of California government code and your policy, and we review this policy to make sure that it's up to date with changes in code and its industry best practices every year. Flip through. Maybe I can flip through. What about that? Okay, so this is a snapshot of the portfolio that we manage here at Chandler. So going back to that comment that I made about interest rate sensitivity. So the average maturity of your longer term investments is still quite short. It's only around 3 years. And the duration of that, which is really the key metric when it comes to interest rate sensitivity, is much less. And that's because some bonds prepay. It's around 2.5 years. So just to give you some numbers, if interest rates were to go up by 1%, the portfolio value would go down by around 2.5%. And going up by 1% right now is, like I said, a very high bar. But it just shows you the sensitivity that the portfolio might have, which is pretty limited. And especially if you layer on that third row there, the purchase yield. On average, you are earning over 4% income every year. So that is another defense mechanism, if you like, against interest rates potentially rising. And during the quarter, we did see interest rates come down a little bit and the value of the portfolio increase. The bigger jump there was due to increased contributions. The staff was being very deliberate, and I would say has timed very well in terms of how the market has trended as we've been looking to grow the longer term investment portion of the portfolio as your overall investment source. This shows how diversified you are, and that's really your first line of defense. You have core holding in treasuries, the most safe and liquid assets, and around that we build in some high yielding, but also high quality sectors and corporates, mortgages, AAA asset-backed securities. And this is the portfolio by rating. You see mostly AA rated because the US Treasury is now AA rated, as is agencies, but we also own some AAA rated asset-backed securities and mortgages, and the corporate securities are a very high quality. So A rated, mid-A, high rated, and above. And we've also diversified by maturity, as you can see in this chart, up to 5 years. That is the maximum permitted maturity within your policy. And then this is the performance. So the performance has been very strong. Last year was a great year for the bond market. You can see that the returns were north of 6%. Unlikely to occur again this year, but if you just go back to that income number that you produced, that is probably more of a realistic number. Still very healthy, and I think will contribute towards your strategic objectives as returns. This is the reporting balances that we also have as part of our package here. So these are all the investments that you hold in your cash or cash equivalent. So money market funds held at River City Bank, funds that you recently allocated towards LAIF. And there is a plan. We are working with staff to continue to optimize and diversify your liquid holdings. That is it. I would just close by saying that it's really continues to be a pleasure working with staff. I think in terms of the investment program, it's something that I know that you're proud of. They've worked very, very well with myself to continue to diversify the portfolio in terms of thinking about longer term investments and shorter term investments and optimizing those shorter term liquid investments. Again, really to think about how to maximize the returns within the context of safety and liquidity to meet your strategic objectives. open to any questions, please.
Thank you, Mr. Delaney. Any questions from the directors? Thank you so much, Mr. Delaney. Thank you, Jeff. Madam Secretary, are there any members of the public who wish to speak?
We do have a member of the public. Robert, can you please approach the podium? We have 3 minutes to address the FRC committee.
Money. It loves money. All right, let's go over a couple of things. You guys invest in Coca-Cola. You guys invest in Goldman Sachs. You guys invest in Toronto, Dominion Bank. You guys invest in Bank of Montreal. Why do you guys invest in other countries? Like, why are we investing in that country and you guys don't invest in anything locally? Am I missing something? It's just about the money. It's not about making a change and doing good things. It's about your paycheck for retirement. Like, let's play the game. So, I do this to Alyssa too, because they put their money into Coca-Cola stuff that's killing us. You guys are doing a great job with sustainability. Let me quote the financial guys. You could go, I don't know how you guys missed this part, but okay. The trust us accounting problem. The agency is reporting a huge 176.5 million increase in wealth. However, the accounting firm they hired, Meyer Accounting, explicitly stated that they are not independent from the agency. Even more concerning, they did not actually verify or audit the numbers, and they left out almost all the standard fine print disclosures. That explained where the money is really going, right? Without that fine print, the accountants say people might reach the wrong conclusions about how healthy the agency's finances actually are. I mean, like I said, how'd you miss that part? It's like the first one. This is the opinion now. The CEO's new rainy day fund. The agency is creating a new stabilization reserve, basically a rainy day fund that could hold up to $125 million. While this is meant to keep electricity prices from jumping around, the new policy gives the CEO power to decide when to move the money into this fund. This could allow the agency to hide extra profits in a reserve before the public ever sees it as a contribution to the agency's bottom line. Thank you.
Thank you for your comment, Mr. Robert. This is a receive and file Treasurer's report for 6-month period ending December 31st, 2025. We'll now go to item number 3, recommend board adoption of resolution approving the rate stabilization reserve policy. This is from Jeff Spengler, Senior Strategic Finance Management and Interim Treasurer, and Mr. Aaron Liu, Rates and Strategy Manager, will present this item. Jeff?
Thank you, Madam Chair. Jeff Spengler, Senior Strategic Finance Manager and Interim Treasurer, joined by Aaron Liu, Senior Rates Manager, correct? Yes, thank you. This first slide is just an opportunity to restate the core objectives that guide our rate setting, which includes competitiveness, rate stability, equity, et cetera. This rate stabilization reserve is a tool that directly supports the 2 boxes that I've highlighted. Only 1 box is highlighted on my screen now, but the 2 boxes that should be highlighted are both rate stability and reserves. This protects our ability to meet cost recovery and be transparent through expectations. Next slide, please. Our recently adopted financial reserves policy provides for the funding of a rate stabilization reserve using excess reserve money. The core purpose is to defer revenue recognition in strong years and apply it when it's needed to stabilize rates or meet to other financial objectives in down years or poor years. According to the accounting rule, GASB 62 allows for deferring the accrual of surplus revenues, where deferrals actually reduce the net position in a given year and then increase the net position in the year that it's recognized. This is frequently used to meet financial covenants and smooth or stabilize rates in down years. The treatment of a rate stabilization money when designated for rate stabilization, these amounts remain part of unrestricted cash and investments and are reported and are transparent for the public. Establishing a rate stabilization reserve under GASB 62 typically requires board approval and a formal policy, including targets and a draw and or transfer conditions. That's why we're here with this recommendation today. Next slide, please. Mechanically, this is a fairly simple process. Again, in a strong year, we can defer revenue recognition, and in a weaker year or during rate setting, we can recognize it to reduce volatility and to smooth customer rates. The financial statement impact, as you can see on this example that we've provided from Marin Clean Energy, the deferral reduces net position in the year that it's set aside, and then it's recognized in the year that it's used. The deferral actually shows up as a rate stabilization line item under operating revenues, and then a deferred inflow of resources on the balance sheet. This is a rate smoothing tool. This basically, again, the Marin Clean Energy example shows how it could be used. This actually shows two deferrals. So they have a total balance. If you look at the chart on the right, they have a total balance in the rate stabilization fund of 70 million that they could use to smooth rates. And I don't know if that is still current. That was a 2024 total. So I think they typically use it over time. Next slide, please. This policy aligns three existing directives. Our rate development policy, which emphasizes rate stability as its core, with only annual adjustments is our preference, and references the use of a rate stabilization reserve as a mitigation tool. It aligns with our financial reserves policy. The recently designated reserve policy allows reserves between the target and the maximum up to 45 days cash on hand to be designated as rate stabilization reserves and used over time for smoothing customer rates. And it aligns with our strategic plan for fiscal year 26 through 28, which included the development of a rate stabilization reserve and targeted a balance of 70 million to mitigate fluctuations and downturn risk. Next slide, please. This table shows that the peer CCAs use similar constructs, generally tied to thresholds like percent of revenues, net position triggers, or explicit board approval for use. Adopting a rate stabilization reserve policy is consistent with sector practice and supports credit and counterparty confidence. Next slide, please. And this just is a snapshot of most recent financials from other CCAs and the sizes that they have for the rate stabilization reserve. Our proposed structure and sizing approach is well within the range of our peer practice. And with that, next slide, and I will turn it over to Aaron.
Good afternoon.
No red button. Here.
Good afternoon, directors. Good afternoon, directors and the general public. My name is Aaron Liu, Rates and Strategy Manager at Community Power. Thank you, Jeb, for covering the policy aspect of the rate stabilization reserve. I want to talk a little bit more about the details in terms of parameters of implementing the reserve policy itself. Next slide, please. So we'll start with the use cases. Really, the main purpose of the rate stabilization reserve is to reduce year-over-year rate changes, as well as maintain rate competitiveness between community power as well as the incumbent utility. And one way to do that is to mitigate rate volatility caused by market price benchmarks that feeds into power charge indifference adjustment rates we've seen rate fluctuations throughout the years, throughout history. We've talked about that during the last rate setting process, as well as when we adopted the reserve policy itself. The use cases will also be able to meet required financial covenants to maintain good standing with financial institutions, counterparties, as well as credit rating agencies. And some of the examples in terms of rate volatility that may be outside of the power charge and different adjustment fluctuations could be providing relief during extreme exogenous events such as socioeconomic events, recessions, natural disasters, pandemics, mitigating bill impacts of climate change-induced events, as well as enhancing affordability for low and medium income and communities of concerned households. Really, the overall purpose and use case for this reserve is to mitigate and try to tackle unexpected significant impacts to revenues or expenses for the organization. Next slide, please. So consistent with the financial reserve policy, an amount up to and including 45 days cash on hand is allowed as eligible for recognition from the total reserve balance for the target RSR balance, the rate stabilization reserve balance, which corresponds to approximately 125 million per analysis from the most recent revision to the financial reserve policy. This amount would cover approximately 30% of the full risk of the market price benchmark volatility discussed and corresponds to roughly 10% of operating revenues or 12% of operating expenses per Community Power's fiscal year 2026 adopted budgets. And these coverages track with general trends of this type of rate stabilization reserve coverage among our peers at the other CCS. Next slide, please. Two key decision points in terms of triggers and approvals for utilizing the reserve. So the first decision point will occur before the end of the fiscal year, i.e. usually June, to determine whether to transfer any revenue from that fiscal year to the reserve. And thus, this decision must consider the fiscal impact of reducing the net margin for the year by the amount transferred. This rate stabilization reserve policy authorizes the CEO to make that decision, and staff will report to the board at the next regularly scheduled board meeting. The second decision typically will occur during the rate setting process itself, which is typically in the first months of the calendar year, 2026, that was January, when Community Power staff recommended a rate change to the board. This decision determines whether to recognize any revenue from the rate stabilization reserve for a specific use case, such as mitigating a rate increase that would otherwise be necessary to meet expected costs to serve customers. The policy requires that the CEO recommend this recognition to the board for approval, which would typically occur during the same board meeting at which staff recommends a rate change. Staff may also recommend recognition of the revenue from the rate stabilization reserve for an alternative use case at other times of the year, subject to board approval. Next slide, please. And lastly, since we talked about using and transferring the revenue, we also want to talk about replenishing requirements as well as guardrails. So in terms of replenishment, policy itself also dictates that staff must incorporate a plan for replenishing the reserve. A decision to recognize revenue from the reserve itself is approved. So this plan may be presented at the same board meeting at which staff recommend recognition of revenue from the rate stabilization reserve for rate stability or another use case, or staff may present the plan at a future board meeting as an update to the board, given the fast pace and urgent nature of the rate setting process itself. And the plan should describe what measures Community Power may take within 2 to 4 years to replenish the rate stabilization reserve if it is deemed feasible. The overall goal here is really to provide a tool to support rate stability while protecting Community Power's financials. Next slide, please. And in terms of the proposed timeline, just a quick refresher looking back in December 11, 2025, where the board approved the updated financial reserve policy. In December, Community Power staff started drafting this rate stabilization reserve policy. New 2026 rates were approved mid-January, and now we've finalized this rate stabilization reserve policy, aiming for board approval March 26th. And the first trigger point that I spoke of before in the beginning of the fiscal year, if staff determines whether to transfer revenues and recognize that revenue to the rate stabilization reserve. And then again, the second trigger point right in the beginning of 2027 rate setting if revenue needs to be recognized. Thank you. That completes our presentation. Happy to take any questions.
Thank you, Mr. Lu. Sandra, do we have any public comment on this item?
We do, Madam Chair. Robert, can you please approach the podium? We have 3 minutes to address the FRMC committee.
Back. Right. I mean, one thing I would just reinforce, which I think staff did say that, I didn't want to misconstrue everything. I was listening. But I think it should be written that it should require a majority vote. Right? Not just that they vote on it or agree to it or consent to it, but that a majority are voting on it to move the funds. And so, it's funny because in the documents, it shows like what they're gonna sign as if it's already written, and it's at the meeting. We're not even at the meeting, but you guys are showing the paper as if it has the signatures, which, like I said, I think it should require a majority vote. So yeah, that was the first one. Require a board vote prior to any moving of the money. And I just find it interesting that you would have this fund set up right now for an emergency, but not know how to replenish it. Like you're gonna figure it out later once you take the money out. Like you figure, how'd you get the money? Wasn't that the plan? Just gotta question some adults sometimes because I don't know where you're taking the money from, but obviously if you took it from there, you could take it again, right? So I think you guys need to have a little more of a game plan. You guys are gonna have a slush fund or a rainy day fund or a sustainable pricing fund, keep pricing down. You should probably have an idea of how you're going to refill it once you take from it. Before you even start taking from it. This says they'll figure it out once they already take from it. Yeah. Yeah. I don't like the 15-minute city stuff. I want us to be fiscally responsible too. And I can see that you guys are trying. But we want a little more transparency, maybe highlighting the changes so the public can easily find what you're changing in a huge list of numbers. Thank you.
Thank you, Mr. Robert. Members, are there any comments from you with regards to item number 3? Vice? No.
Well, okay, yeah, I do have a comment. I just think that, thank you. Thank you for your presentation. I think that it was pretty clear and made it clear. I think it's a good idea to have the rate stabilization reserve, to put it put it on the site, especially in light of the volatile economic present that we have. So, I'd like to move to adopt it.
Second.
Thank you. We have a motion and a second. Thank you, Mr. Spangler, Mr. Lu, for the presentation. I think the presentation is very clear. The recommendation is to recommend board adoption of resolution approving the rate stabilization reserve policy. I have a motion and a second. Madam Secretary, call the roll, please.
Director Insunza,
Yes.
Vice Chair Suzuki,
Yes.
Chair Yamani.
Yes.
Motion carries, Madam Chair.
Thank you. Moving on to item number 4, recommend board adoption of resolution authorizing San Diego Community Power to join the California Community Choice Financing Authority as a founding member. Mr. Jeff Spangler, our Senior Strategic Finance Manager, and our Interim Treasurer will present this item. Jeff?
Jeff Spangler, thank you, Director. Jeff Spangler, Senior Strategic Finance Manager, Interim Treasurer. I promise this is the last time you'll hear from me this evening. But wanted to bring this exciting opportunity to you all. And I've been actually excited to say this. Triple CFA, just by way of background, Triple CFA is a JPA formed by CCAs to act as a conduit issuer for tax-exempt financings. It's a mouthful, but I enjoyed saying. This is a recommend authorization for Community Power to convert its membership in Triple CFA to become a founding member. There's a large governance benefit to Community Power of becoming a founding member. And what that does is it allows us to have a board seat at Triple CFA and provide additional direction that we don't currently have as an associate member. Just by way of background, we have now completed 3 Triple CFA clean energy prepaid transactions, totaling nearly $2.7 billion, including the transaction that we closed just this morning. We realized just over $7 million in actual energy cost savings through, I think it's January or February of 2026. At this point, we actually meet all eligible criteria and continue to expect frequent and ongoing use of Triple CFA for future prepaid transactions. There's no incremental costs of becoming a founding member versus what we pay through either transaction fees or membership fees that at the associate level. Those are the same for all members of Triple CFA. And with that, I just recommend authorization of the resolution to approve becoming a founding member of Triple CFA.
Thank you, Mr. Spangler. Madam Secretary, do we have a public comment on this item?
We do, Madam Chair. Well, could you please approach podium? You have 3 minutes to address that in the committee.
Mr. Robert?
Thank you. Back. Appreciate it. Short, short, sweet. The public needs to know more though. I agree. It's just like, okay. The recommendation for San Diego Community Power to become a founding member of the California Community Choice Financing Authority, CCCFA. I want to voice support for this move while asking specific commitments regarding how the benefits will reach taxpayers. According to the staff report, San Diego Community Power is currently an associate member, which means we participate in financing but have no seat on the board and no say in the rules. Moving forward, or moving to fund the founding member status finally gives San Diego a seat at the table to help shape the governance of this authority. This is critical because the report states that clean energy prepayment transactions can, through the CCFA, are expected to save our agency over $20 million annually. However, we take on the leadership role. I have 2 questions for the committee. Direct ratepayer benefit with $20 million in annual savings projected from these transactions. How exactly will the savings be reflected on consumer bills since our rates are currently 150% the state average? Will these savings be used to directly lower rates, or will they simply be used to build up the reserve discussed in item 3? Transparency standards. As a founding member, San Diego Community Power will help set the operating standard for CCDFA. Given the concerns rise today regarding item 2, specifically used an accounting firm that is not independent and omissions of standard financial disclosures, will SDCD, San Diego Community Power, use the new leadership position of the CCFA to champion fully independent audits and high transparency standards for these multi-million-dollar bond transactions. We support San Diego Community Power having a strong voice in state financing, but we want to ensure the governance influence is used to protect ratepayers and demand the financial clarity that has been missing from today's other reports. Thank you.
Thank you, Mr. Robert, for your comment. Members, this is a recommendation to the board adoption of resolution authorizing San Diego Community Power to participate as a founding member of the California Community Choice Financing Authority and approving execution of the CCCFA Joint Powers Agreement. You have a comment? Otherwise, I'll entertain the motion.
Motion to approve.
Thank you.
Second.
Thank you. Thank you, Mr. Spengler, again for explaining that properly. And we do be at the table to take care of our ratepayers for the business. Madam Secretary, can you please call the roll?
Director Insumsa,
Yes.
Vice Chair Suzuki,
Yes.
Chair Yamani,
Yes.
motion carries, Madam Chair.
Thank you so much, Madam Clerk. We'll now go on to item 5, update on 2026 projected community power rates. Mr. Aaron Liu, Rates and Strategy Manager, will present this item.
Good afternoon. Happy, and it's my pleasure to provide an update for the 4/1 rate adjustment. So I'll start with looking at the timeline of where we are today. As spoken about earlier, we finished our 2026 rate setting cycle early 2026, but on March 2nd, SDG&E, San Diego Gas and Electric, filed an advice letter on its general rate case phase 2 rate design changes that we were expecting. Those rate changes will be implemented on April 1st, and this update is really an assessment of what was filed in that advice letter and a briefing of all the different rate design changes as well as the rate structure changes that have been incorporated. And just to jump ahead a little bit, community staff is actively assessing those changes and will be bringing a recommendation to the board on March 26th, 2026, next week, in terms of rate scenarios moving forward. Next slide, please. Going back again on the rate development policy objectives, our goal and aim is always to balance as many of these items as possible when we either set develop rates or, in this scenario, adjust rates. Next slide, please. A quick refresher on rate components itself. Community Power sets and charges for purchasing or generating electricity on behalf of its customers, and that's the generation component of a customer's bill. SDG&E is responsible for the delivery of electricity for all customers. We also have the PCIA, the part we're charging difference adjustment rate, which is above market costs related to procurement commitments that SDG&E has already made before their customers departed to a CCA program. And finally, franchise fees are surcharges applied to all customer bills for electricity transported over SDG&E systems that are constructed in the public right-of-way. And here's a graphic of a illustrated joint rate comparison between San Diego Gas and Electric's default product and Community Power's different products as of January 1st, 2026 from the most recent rate set. Next slide, please. again, we are recommending moving forward with 3 sets of rates, in another word of rate stratification to achieve equity, because the PCIA has different vintages assigned for different customers that were enrolled into community power. Based on phases, those customers with different vintages are charged different PCIA rates. And due to the substantial delta between the PCIA rates and thus the vintages, staff continues to recommend 3 sets rates to the board to ensure customers are all getting the same value proposition in terms of community power rates. And that really maintains fair, equitable, and balanced rate structure for all customers. Next slide, please. So in terms of SDG&E's general rate case, the rate case application was filed back all the way in 2023. The commission finally adopted a decision on all the proposals in that application in September of 2025. One of a larger item that we've already talked about before, but SDG&E is required to present the power charge and difference adjustment rate on bundled customers, so customers that are served by SDG&E for generation delivery, as a separate line item to ensure consistent comparison between SDG&E's customers and CCA's customers. That was expected in April 2026, but SDG&E just filed a advice letter to push that implementation into 2027. So we are probably looking at starting to have a robust discussion regarding that implementation time. But the other items that are related to more of the rate design and rate structural changes will be implemented on either 4/1 or has already been implemented as of January 1, 2026. 3 items to highlight here: the seasonality adjustment for residential tier rates, so moving the seasons, winter and summer adjustment from delivery rate component to the commodity rate component, of reducing that volatility between the seasons in the generation rates. That's already in effect. The 2 other pieces that will occur on April 1st is the time of use super off-peak extension. So the existing midday super off-peak that only exists currently for March and April will be extended to all year round between 10 a.m. and 2 p.m. And then the other piece is the establishment of a new medium commercial customer class. That customer class is defined with demand between 20 and 200 kilowatts. That's also effective on April 1st, 2026. Next slide, please. Some of the other changes and more detail, just want to highlight here that relates to the rate impacts that you'll see in the next few slides. Are revenue allocations for each customer classes is being updated. So what a revenue allocation is SDG determines from each customer class, whether it's residential, commercial, agriculture, so on, what revenue should be collected in order to align with cost of service. So that's being updated since the last update was in 2019. There's also alignment on low income discount methodology for commercial customers to that of residential customers. So residential customers that we are mostly aware of, care customers, they have a discount line item on the bill. So for commercial customers, that will be happening as well. There's also a medical bed baseline discount adjustment as well. Also, some of changes on the delivery side of the bill. So annual increase to commercial monthly service fees. Those are going up for all commercial customer classes, as well as distribution rates are being updated for various tariffs. So you're going to see some of these impacts flow into the next few slides. That's why I want to explain these upfront. Next slide, please. So I just want to highlight SDG's bundle commodity and generation rate change. We always highlight these before any rate change, since they are of most importance to us as a competitor. So here, SDG system average commodity rate is projected to remain relatively unchanged. If you look at the last line on this table, system total is a minus 0.11%, relatively unchanged. But if you look a little bit more closely to some of the customer classes, you do see larger changes. For example, I want to highlight small commercial commodity rate is going up by almost 2%, and then agriculture is the reverse, it's falling by almost 8%. And those are mostly driven by the new medium commercial class carve out for small commercial, and then agriculture is driven really due to the revenue allocation. So some of the revenue allocations that was earlier allocated to ag is now being moved to residential. Next slide, please. PCIA, there are some changes as well. It's really noticeable for some of the classes. So again, here you see small commercial PCIA is dropping by almost 33%. Again, from the medium commercial carve out. Large CNI is also from the medium commercial carve out, since there's some of the tariffs moving between those three customer classes causing this change. And then ag here, just similar to the last slide, around an 8% change, purely due to revenue allocation movement from ag to residential. Next slide, please. And then just to complete the whole picture, delivery side here, overall system total, the last line of item, delivery rates are going up again, really driven by additional $590 million in wildfire related recovery costs. That's been okayed by the commission since last year. But here, lighting, which is mostly street lighting, it's a large drop in terms of delivery side of the bill, really due to an update on lighting distribution rates. Next slide, please. So again, this is the first part. This is the assessment. Next steps, staff is continuing to conduct rate analysis and will bring to the board a rate update recommendation on March 26th, so next week. And secondly, due to variations in the PCIA for the vintage years, we will continue to bring forth these experts. So that completes my presentation.
Thank you for your presentation. Madam Secretary, do we have any public comment?
We do have a member of the public. Robert, could you please approach the podium? You have 3 minutes to address the FRMC committee.
Hello, I'm back. Out of all the presentations today, the documents have been widely available. And it just concerns me that this presentation wasn't made available to the public before. I went outside to see if you guys had copies of it on the paperwork. It's not on the paperwork. There's links that are listed within your guys' documents, but you're not releasing the full. I found 3 more pages right here, and then I've got to open 2 more links in here. So it seems like there's a lot of paperwork missing from this item. As far as what the public, I mean, we didn't even see a copy of that in the paperwork. Yeah, you can add it after. But if you guys want public to be engaged before the fact, I mean, the slide was in it, right? Like you guys had one of those slides in it. So I knew it was ready before this meeting, yet it's nowhere within the paperwork. It's in links. So, you know, I'm wondering how many more times that's happened and how many more times there hasn't been the paper, you know, all of it in one. And so I encourage staff to be more transparent and have all of the materials provided to the public before the meeting, especially if you're going to use one of the slides as a piece of the material, but leave out all the paperwork in a PDF link. Every other person put all their slides in. You know, it's important that the paperwork's done correctly because it's the most basic of it, you know, And so this is not the first board that I've had issues with, and I appreciate you asking for public comment after the presentation. That was a problem last time, and I really appreciate that. There are other boards that are still setting the public up for failure, right? And so I appreciate the way, I wanted to end this on a good note and say good things, right? So I appreciate the transparency in that and giving the public a fair opportunity. I look forward to more meetings. Like I said, I cover a lot of stuff, so I'm not an expert on anything. But if I can help spread your guys' message and let the ratepayers know what's going on here, that's my whole goal. I encourage you guys to watch the videos I release. I record the Zoom too, just in case there's any hiccups. I'll write an article about it and publish it. And I just want to reassure you guys, I come here with the most honest means, and I want to help my community. And I think you guys do too. So thank you for this opportunity to speak. And I look forward to more documents being made available.
Thank you for your comments, sir. Are there any members of the board comments or questions? This is a receive and file update on 2026 projected community power bids. Thank you, Mr. Liu, again for the presentation. I have no comments from the board. And we had taken up item 6 already. So are there any other members of the committee? Any announcement?
No.
No announcement? No announcement. That brings us to the end of our agenda. I appreciate everyone's participation today. The next regular FRMC meeting will be held on Thursday, April 16, 2026 at 4 p.m. here at Chula Vista Council Chambers. We are adjourned.